Investing in stocks can be a daunting process for new investors, but it doesn't have to be. With this stock analysis guide, you will learn how to invest in stocks and do a quick and easy stock analysis. It is not always easy for new investors to know where to start when it comes to investing. This video will show you how you can do a quick and easy analysis of a stock. A stock analysis is the process of examining the fundamentals of a company, such as its financial statements, in order to decide whether an investment in that company is worth it. Investors often use this information to make decisions about what stocks they should buy or sell. The first step in doing a quick and easy stock analysis for beginners is understanding what kind of information you need to gather before doing your analysis. This includes things like the company's financial statements, recent news about the company, and any other relevant information that might be available on public websites like Google or Yahoo. Finance. Step-by-step guide on how to analyze a stock. Analyzing the company that you wish to invest in is important because taking the time to review the financial history of the companies you plan to invest in will give the investor a better idea of the future that will be held for the company, thus reducing the chances of you making terrible investment decisions. Step 1. Is the P/E ratio lower than 25? A P/E ratio is the ratio of a company's share price to the company's earnings per share. This ratio is important because it serves as a guide as to whether a company is overvalued or undervalued. A low P/E ratio might be the result of a company with earnings growing faster than the company's share price. This usually indicates that the company is undervalued. However, a company with a low P/E ratio and no signs of earnings growth is not an undervalued company. Sometimes P/E ratios do not indicate whether a company is overvalued or not. A company could have a high P/E ratio because it is a company that is growing and attracting a lot of investors. It is recommended that you do your due diligence to value these growth stocks because sometimes it is just hype driving its P/E ratios, and this is a sign of the company being overvalued. This information can typically be found on websites like Yahoo Finance and investing.com. Step 2. Is the 5-year return on invested capital higher than the industry average? Return on invested capital, ROIC, is a formula used to determine how effectively a company allocates its capital. ROIC demonstrates how successfully a company uses its capital to generate profits. To determine whether a company has a competitive edge, it is critical to determine whether its ROIC is higher than the industry average. It's crucial that the business you're investing in has an edge over rivals in its sector. Competitive advantages increased value for a company and its shareholders. The harder it is for competitors to offset the advantage, the more sustainable the competitive advantage is. In order to calculate the company's ROIC, you would have to access their financial information through its annual reports or on Yahoo Finance. To calculate this, you need to use this formula. ROIC equals net profit after tax divided by invested capital. After getting the company's ROIC, you will have to compare it with the average ROIC for the companies in the industry it operates in order to see whether or not the company has a competitive advantage. Step 3. Did revenue grow over the last 5 years? And did net revenue grow over the last 5 years? And are the net revenues 20% of total revenues or higher? A company's net earnings are determined by subtracting all costs and taxes from its income. Here, we learn how much money the business made after paying income taxes. The first indicator to look for is whether the net earnings have historically increased. A single year's entry for net earnings is useless. Instead, you should look for consistency in the earnings picture and an upward long-term trend, both of which are indicative of the durability of the competitive advantage. The historical pattern should be upward. However, the upward trend does not have to uniform. Compared to their rivals, businesses with a sustained competitive edge will report a greater ratio of net earnings to total revenues. Step 4. Is the company buying back shares? Businesses with a long-lasting competitive edge typically have a lot of extra money that they can use to repurchase their own stock. When a company buys its own shares and holds them as treasury stock, it is effectively decreasing the company's equity, which increases the company's return on shareholders' equity. It is important to understand if high returns on equity are the result of excellent business economics, financial engineering, both or neither, or a blend of the two, since they can be a sign of a sustainable competitive advantage. Treasury shares on the balance sheet and a history of share repurchases are strong signs that the firm in issue enjoys a sustainable competitive advantage. This information can be found on the company's balance sheet and cash flow statement. Step 5. Does the company have a good debt-to-equity ratio, and how long will it take the company to pay off its debt? The company's total liabilities are compared to its shareholder equity using this ratio. It emphasizes a company's reliance on borrowed funds and its capacity to fulfill those financial obligations, making it one among the most significant corporate valuation indicators. Depending on the industry, the ideal debt-to-equity ratio will typically differ considerably, but in general, it shouldn't be more than 2.0. The D/E ratio for S&P 500 businesses is roughly 1.6 on average. This is calculated by dividing debt by equity. The company should be able to settle its debts in less than 5 years. This is calculated by dividing total liabilities by 5-year average free cash flow. Step 6. Did cash flow grow over the last 5 years? Exactly why is cash flow crucial? Simply put, cash flow is crucial because without it, an organization cannot function. Lack of funding is one of the key reasons some businesses fail. It is crucial that the cash flow of the company generally shows an upward trend. You can calculate this by using the new 2022 to old 2018 divided by old 2018 times 100, and the amount you get should be positive. Step 7. What is the price to free cash flow? A measure of equity valuation known as price to free cash flow, PFCF, compares a company's market price per share with its free cash flow, FCF. An excessive price to free cash flow ratio could be a sign that the business is overvalued. A low ratio of price to free cash flow suggests that the company is undervalued. To assess if a company is under or overvalued in the industry it competes in, its PFCF should be contrasted to the ratios of other comparable companies. You can calculate this by dividing the market capitalization by cash flow per share. Step 8. Are the gross profit margins higher than 20%? After deducting the expenses of the raw materials and the labor used to produce the items, the company's gross profit is the amount of money it made from total revenue. Businesses with strong long-term economics in their favor typically have better gross profit margins than those who don't. Any gross profit margin that is 20% or lower is typically a solid sign of a highly competitive market where no company can sustainably outperform its rivals. We will never get wealthy over the long term with a company operating in a highly competitive market without some sort of competitive advantage. This is calculated by net sales, cost of goods sold, divided by net sales. Step 9. Are the company's SG&A expenses under 30%? All non-production costs that a business incurs over the course of a particular period are included in SG&A. Examples of these are rent and advertising. The smaller the company's SG&A expenses, the better in the quest for an organization with a long-lasting competitive edge. It would be best if they could continue to be low. Anything less than 30% is seen as wonderful in the corporate world. Selling plus general plus administrative expense divided by net sales revenue. Step 10. Are the interest payments below 15%? On a company's balance sheet, debt is shown as a liability, and the item for interest paid throughout a quarter or year is called interest expense. Businesses that enjoy a sustainable competitive edge frequently incur little to no interest expenditure. The company with the lowest ratio of interest payments to operational income, regardless of the industry, is typically the one most likely to have a competitive edge. Conclusion: it is not advisable to invest without doing any research. That is why it is a good idea to learn how to do a stock analysis before investing in a company. After conducting all of this research, it should give you a clear idea on whether or not you should put more time into learning more about the company and whether or not it would actually be a good addition to your investment portfolio. Thank you for watching the video. Be sure to leave a thumbs up on the video and also subscribe to the channel for more content.